Hey everyone, and welcome. If you're trying to figure out which annuity company you can really trust with your retirement savings, you are in exactly the right place. But here's the thing. Instead of just giving you a simple thumbs up or thumbs down on a company, we're going to give you something way more powerful, a whole new framework to evaluate any company out there. Let's dive in. So chances are this exact question, or one just like it, is what brought you here. You're looking for a straight answer, right? You want to know if Ceres Life is a safe place for your money. And look, that is absolutely the right question to start with, but it's not the most important one to end with. And here's why. A simple yes or no just doesn't cut it for a long-term commitment like an annuity. A much better answer isn't some label. It's a framework, a way of thinking that puts you back in the driver's seat for this huge financial decision. And here it is. We call it the Durability Plus Fit Lens. It's a really simple two-part test that helps you cut through all the marketing hype and get right to what actually matters for your financial future. So let's break down what each of these really means.
All right, first up is durability. This is all about the company. Does it have the financial muscle and the right corporate structure to actually be around for decades and pay out on its promises? Think of it like the foundation of a house. But then there's fit, and this is just as important. This part is all about you. Do the nitty-gritty details of the product, the withdrawal rules, the fees, what happens when you pass away, do they actually line up with your life and your retirement plan? You absolutely have to get both of these right.
So let's put this framework into practice, shall we? We're going to run Ceres Life through our Durability Plus Fit Lens and use it as a perfect case study to see how this whole thing works out in the real world. First off, it really helps to understand where Ceres Life even sits in the market. Our source material describes them as a modern carrier. Now, what does that mean? Well, it often means they've got more efficient technology and a laser focus on retirement income products. On the other side, you have the legacy carriers, those household names with decades of public history. But here's the crucial point. A company's age is way less important than its underlying financial structure and its capitalization. That's the real test of durability. And this is a perfect example of what I'm talking about. According to our source, Ceres Life got a capital contribution of around $320 million. Now, why does a number like that matter? Well, because as an annuity company grows and sells more policies, it needs a really deep pool of capital to back up those promises and to maintain the massive reserves that state regulators require. A big number like this is a key indicator that they're serious about being in it for the long haul. Now, this slide is really interesting because it's all about how you interpret it. Ceres Life has a B++ rating from AM Best, and I know a lot of people instinctively look for a top A rating, but the source material makes it really clear. A rating is just one piece of the puzzle. For these newer, more modern platforms, it's not at all uncommon to be in this range while they build up a track record. The much more important question is whether the company's business model and its capital are truly aligned with the guarantees that they're selling you. And this right here, this brings us to a really critical shift in focus. We've been talking all about durability, the company's financial strength. But the real source of frustration, the reason most annuity owners get upset, it has very little to do with the company's solvency. It actually has to do with something way more personal. I want you to pay close attention here, because this is probably the core insight of this entire explainer. Most of the time when people are unhappy with their annuity, it isn't because the insurance company went under. No way. It's because the specific product they bought was a terrible fit for their actual needs, right from the very beginning. Put simply, they didn't really understand the rules of the road they'd be driving on. And here is almost always where that mismatch happens. It's in the fine print. How much money can you actually access each year without getting hit with a huge penalty, what they call a surrender charge? What are the exact options your spouse or your kids will have when you pass away? Are there hidden fees for extra features, called riders, that you might not even need? And how does the company decide your interest rate in year 2 and 3 and beyond? You see, misunderstanding these details is what turns a financial solution into a financial trap. So, how do you avoid that product mismatch? How do you make sure you get a good fit? Well, you do it by asking better questions. So in this final section, we are going to give you an actionable checklist that you can use with any provider to get the real answers you need. Think of this as your personal due diligence cheat sheet. Don't just ask if the company is good. Ask these specific, practical questions. For instance, can you take out your required minimum distributions, those mandatory IRA withdrawals you have to take, without getting slapped with a surrender charge? The answers to these questions will reveal everything you need to know about whether that product is a good fit.
This is how you go from being a passive buyer to a truly informed consumer.
And so here we are, full circle. We started out by asking if a company is good, but we end up here. The ultimate question isn't just about the company's durability, it's about the product's fit. Is this specific contract, with all its unique rules and features, the right tool to help you achieve your specific retirement goals? Answering that question, that is the key to making a decision you'll feel great about for decades to come.